Cool. All right, we've got 8% interest rates that may be on the horizon. Real estate asking prices starting to stumble, and government deficits finally starting to matter. There's been some shifts in the economy today, or at least news reporting on it, and it's not looking any better than it did yesterday. Kyle, what do we have today?
Yeah, we got a few things. So the first thing we're going to do is actually jump in and talk about why 8% mortgage rates aren't crazy. So the Wall Street Journal says with fewer buyers for mortgage bonds right now, the rates on home loans can go unusually high. And I think a lot of us are feeling it, especially the real estate investors out there. Treasury yields are jumping higher, but even that doesn't explain how high mortgage rates are getting. Home buyers might wonder whether typical mortgage rates could soon hit 8%. So historically, that answer might have been that this was unlikely without a dramatic change in treasury yields, even though 10-year yields are going to 5% from 4.8. But the answer in today's market, that might very well get there. So one big reason is a change in who is buying the government-backed bonds. That pull many home loans into investments, which in turn drives the market price of a standard mortgage. For years, the Fed or big banks, and often both, were significant and somewhat indiscriminate buyers. Now it's not the case. The Fed is trying to shrink its balance sheet, and banks are working to overcome the effects of rising interest rates. In the first half of 2023, banks and the Fed collectively reduced their portfolios of so-called agency mortgage-backed securities, MBS, by about $207 billion, according to figures compiled by strategists at Bank of America. So first point here is the Fed and banks collectively have slowed down in their buying of mortgage-backed securities, primarily trying to shrink its balance sheet and cut back, right? They're tightening the belt a little bit. Anything you want to add to that, David?
Yeah, people are wondering what the heck this has to do with rates. I think that the general consensus people have is actually not accurate. They think that when the Fed raises the prime rate, that is them raising the mortgage rates, and that's not the way it works. Mortgage rates are basically determined by how much an investor is willing to pay to buy the note or the loan that you're given when you go to buy a house. So you go apply for a mortgage to buy a house. The person who gives you that money, they're not probably going to service that loan. They're going to sell it to someone else. That end buyer is ultimately the one, the demand in that market for what interest rates are. Now, if that end buyer's like, man, I got all this cash, I need somewhere to put it, let me go buy a bunch of mortgages. Well, they put mortgage rates really low, because then more people are likely to go apply for a loan and they have more products that they can sell to someone. And that's been the case for the last decade because we had a bunch of money floating around from all the stimulus. Well, as the investors are starting to get nervous about defaults or what's going on in the market, it sort of creates this self-fulfilling prophecy where they say, you know, we don't know if we want to buy mortgages because we think people might default. So in order to be able to create a mortgage to sell to that person, the originator has to give it a higher rate because they're more likely to buy a loan with an 8% rate than a 6% rate because that 8% is going to them. They're getting a higher return. So you end up seeing higher mortgage rates happening when there's less people that are willing to buy them because you got to make the juice worth the squeeze.
Yeah, and on top of that, there is a profit earned by mortgage originators who make the loans and then sell them into the market. The end result is that typical 30-year fixed rates on new conforming mortgages at more than 7.4% of the end of September have jumped far ahead of the 10-year treasury yields than at just under a 4.6%, according to the Intercontinental Exchange rate data. So this 3 percentage point gap is actually pretty big, right? The pre-pandemic average from 2017 to 2019 was under 2 points, according to ICE data. It's narrowed slightly from earlier this year when mortgage bond portfolios of distressed banks were being sold off. Still, it raises the possibility that even without more failures, banks moving just to trim their portfolios to raise cash could help keep the gap about where it is, effectively turning just a 5% 10-year treasury yield into an 8% mortgage rate.
So what do we need to know from this article? Basically, don't be surprised if rates keep rising. That's what they're getting at here. This is an actual reasonable expectation that rates could hit 8% because banks are having a harder time finding people to buy their loans, which I would think is an indication that the people that buy these loans don't feel safe about them. They think people are more likely to default. Now, the interesting thing is if banks or if mortgage-backed securities stop buying these notes and banks have to increase rates in order to get them to buy them, real estate prices may start to come down. And if that does trigger a cascade like it did in 2010, I'm not saying it will, but if that happened, it would actually create the foreclosure problem that those mortgage-backed securities are worried about happening. And that's what's silly about the economy that we live in today. It's all psychological. All these pieces are connected. And when somebody gets afraid of something and they stop spending money or they stop investing in things, that can create the domino effect that leads to a big problem, which is why you should just expect that with economies, they tend to go up in steps like stairs and they tend to go down like an elevator. They crash. But when they go down, eventually, when everything settles out, they go up. And that is how the trend tends to work. But we always worry about the moment where it's going to go down. Very few people are playing the long game, but here's just something to be aware. If you were thinking I'm waiting for rates to go down before I buy real estate, hey, you got to buy real estate when it makes sense for you, but I wouldn't assume that they're going to go down. There's news here that they may be going up.
Yeah, and to sum it up, right, I like what Gianna Curro here, head of the agency MBS strategy at Bank of America, she says, once there's clarity from the Fed, mortgage spreads should tighten. Those on the sidelines could probably get involved again, which could include overseas buyers, right? More investors, more money coming in. But further down the road, banks themselves could again become those major buyers of the MBS, particularly if they're doing less direct mortgage lending under the new capital rules. But for now, even with central bankers puzzling over whether rates have risen enough or too much, it seems possible that the market might not get the clarity in time to keep mortgage rates from touching those next tiers. So, as you mentioned, David, don't be surprised if the interest rates continue to go up.
Very good point. All right. What do we got next, Kyle?
All right. Next one we have up is real estate asking prices and what goes into that. We're going to be specifically talking about buyers, sellers, psychology, concessions, pricing, all that kind of stuff. So let me pull that right up.
So we've been hearing for a while, while you're pulling that up, Kyle, we've been hearing for a while that prices could be coming down. Now, keep in mind, there's a difference between prices correcting downwards and collapsing downwards. You often hear people talk about this huge collapse. I don't know that that's what the article is saying here, but it might be nice if prices started to come down a little bit. And we just took a little bit of that ego away from the sellers and started to give the buyers a fighting chance again. So what do we have here?
Yeah, so the real estate market, always a dynamic, ever shifting landscape, right? Going up, going down. We've had a twist. Mortgage rates continue to go up. Home sellers are reevaluating their asking prices. Money.com actually reported that the average 30-year fixed mortgage rate hit a 2-decade high of about 7.65, right? We've been hearing everybody talk about coming up to 8%. Data suggested buyers are distressed and sellers have little choice but to lower their asking prices. Competition is cooling off remarkably fast, even for this slower time of year, according to a fall outlook report from this listing from Zillow, basically. So the question is now the right time to buy, sell, or stay where you're at?
Well, it all depends on what the buyers are doing, right? If people collectively just say, we've had enough of this, we're not buying homes, we may find ourselves in a bit of a stalemate. Okay. So sellers may have to drop their prices. My gut would tell me most sellers would just stay put. They would say, look, I'm not dropping my price. If you don't want to pay the price, that's fine. I just won't sell. And inventory in general will dry up and it won't be hitting the market as much. But if this goes on long enough, buyers could take back some of the power in the market and sellers would have to drop their prices.
Yeah, I agree. And I think individually it comes down to the motivation of that seller, right? If the seller's comfortable and they have no need or reason to move anywhere, yeah, they're going to stay put on that price because they feel like it's worth what it is or what they have it listed at. But more importantly, they don't want to go and buy a new house with these huge interest rates, right? And so, but if it's somebody who has to move to a different city for work, or they're getting deployed in the military, or they've got some other sort of distress that they're under. Maybe they're getting a divorce or something like that. There might be opportunities for buyers to get some of those concessions or those price reductions. So
All
this
right.
article says, oh, go ahead.
Nope. I was going to ask you to keep going.
Oh, yeah. So the focal point of this real estate conundrum is the surge in mortgage rates, right? So in 2023, rates climbed to a high, a phenomenon driven by various economic factors. Rising rates directly influence the affordability of home ownership. Others have opted to keep renting until the market cools down. So we are seeing a lot of people sit on the sidelines. But the impact of rising rates is felt throughout the real estate ecosystem for buyers and sellers. And the evolving situation underscores the importance of an informed decision making and financial preparedness for anyone navigating the complex real estate. What do you say, David, for the people who are sitting on the sidelines, who are questioning potentially getting into the market?
I think that it's okay to be doing so right now, as long as you're taking action in other areas of your life. So, my advice is going to come from the pillars of wealth philosophy that if you're not investing your money right now, that's okay. As long as you're saving more of it, you're increasing your savings, or you're making more of it by working more or starting a business. There's lots of different ways to build wealth, really, that comes in three different forms. But you got to focus on those three things. And the last 10 years, investing has been the best pillar to focus on because we had massive inflation. You couldn't really save your way into wealth. But now that you're having less investing opportunities, just look at how you can save some more money or make some more money.
I love it. Yeah, and this article says it really, really well, right? You have to look at the home buyer's perspective, right? For people that are on the sidelines, thinking about jumping in, thinking about buying a house, maybe it's their first house, right? This market has caused a lot of shifting challenges, and so making sure that you've got your pillars set up, like you mentioned, David, but also making sure that you're looking for the right property. You're not settling. Buyers are right now are going to be much, much more specific about the costs involved with that house. 2 years ago, when they would have bought that house, they would have just thrown all the money at it. They didn't care what condition it was in. They just wanted to get their offer accepted. Now buyers are being much more diligent about the purchase and everything that's involved in that property. And they're definitely minding their P's and Q's a lot closer.
Yeah, what I'm seeing in general and what I think we'll probably continue to see is not necessarily huge fluctuations in the value of real estate. I don't think that the prices are going to collapse. I don't think that they're going to shoot up higher. I think we're probably going to be seeing a decrease in the amount of transactions taking place.
Yeah.
So we tend to only think about real estate from the perspective of what's it worth as opposed to, well, how much trading is happening. But that's a metric that you should be thinking about as well, because it helps the health of the economy. Like, just something to think about. If houses were dropping in price by 1% a year or 2% a year, we would tend to think that's bad because it's going to be lowering the GDP. But if they're doing it at a really rapid rate, tons of them are changing hands every single day. There's lots of revenue being created every single time the dollar changes hands. And all these people are making money. So even though the value of the asset goes down, the health of the economy is going to be going up. Right now, we kind of have the opposite of that. As transactions aren't taking place, real estate agents, loan officers, mortgage companies, interior designers, title companies, escrow companies, photographers, home inspectors, home warranty companies, handymen, contractors, landscapers, painters, all roofers, all these people that make their living from doing stuff with homes are getting less work. That
Mhm.
means they're going to be making less money. So I've often said before, the economy and the real estate market are connected, but they're not 100% connected. You can have a market that's resilient and prices aren't dropping, but you can have the economy that does really poorly if transactions aren't taking place. And that's just something to think about. What I think we're doing is we're slipping into a recession right now because less work is being done, less money is being made. We're not feeling it because we have a lot of money in reserves, but those reserves are being drained by most people. There was an article that we'll probably be doing a video on later that says that homeowners or the average American is expected to be out of money by January. That slowly all that money that's been saved up is starting to go away. And if that happens, you're probably going to see immediate stop eating out, stop spending your money on stuff. Even less money is going to change hands. And that's what puts you in the position to possibly go into a depression. So we're just here to let you know, don't wait until it gets bad before you take things serious.
Yeah, that's exactly right. Financial preparedness is super important. We got one more that we're going to get to here before we take it home. This one is actually from the Wall Street Journal. Rising interest rates mean deficits finally matter. Investors ignored deficits when inflation was low. Now they're paying attention and getting worried, right? It's kind of interesting because what you see on Wall Street is very much what you see on Main Street, right? We could say the same thing about the average mom and pop business owner or just the average W-2 worker where, yeah, when the money was coming, maybe your income was high, or maybe you were a real estate agent, or you're in the real estate industry, you're making money hand over fist. It's very easy to not focus on the spending, to not focus on those financial preparedness
Yeah.
measures, and so you end up you're getting worried, right? And we're seeing the same thing on Wall Street too.
Yeah, like we were just talking about, people tend to have money in reserves. And so even though they're not making as much money, they don't make the cuts until they feel poor, they feel broke. I think the same dynamic may be happening with the Fed. We've taken on incredible debt. Really,
Yeah.
like Thomas Sowell, he's a guy worth looking up. He has a really good quote. I don't want to butcher it completely, but it's something along the lines of when you're trying to figure out like how should money be spent in an economy or should people be taxed, he's like, there's no benefits, only compromises. Basically, the idea is there is no way to just create wealth out of thin air. You have to take it from one place to give it to another. So if you want to fund a social program, you got to take money from another program. Or if you want to fund this program and don't want to take it from another, then you have to tax the people that made the money. And if you want to give people more money back in the form of lower taxes, well, then the government may have to cut some of the programs. Like, this is the way that life works. You don't just have unlimited money, but it sometimes feels to us like we do, because we don't see how the big machine plays. It's all I know is I'm getting paid. All I know is I have this money. Well, in order to put all of the stimulus into the economy that the government did, they had to create that from somewhere. And basically, they took on debt, just like a family that's spending a lot of money, taking its kids on vacations, is probably either racking up debt or cutting into their savings. The government works the same way. So can you explain, Kyle, what this article is talking about on that matter?
Yeah, so we're basically going to zoom out and talk about what does this mean for us as a country, not necessarily just for you as an individual person, right? So the US has long been the lender of the last resort to the world. During the emerging market panics of 1990s, global financial crisis 07 to 09, the pandemic shutdown of 2020, it was the Treasury's unmatched capacity to borrow that always came to the rescue. Well, now the Treasury itself is a source of risk. No, the US isn't about to default or fail to sell enough bonds at its next auction, but the scale and upward trajectory of US borrowing in absence of any political corrective now threaten markets and the economy in ways they haven't seen for at least a generation. The usual suspects can't explain it, right? The inflation picture has gotten marginally better, and the Federal Reserve has signaled it's nearly done raising rates. So deficits have been wide for years, but why do they matter now? A better question might be, what took so long? The larger deficits push up long-term rates and had long been economic orthodoxy, but for the past 20 years, interest rate models that incorporated fiscal policy didn't work. Noted Ricardo Trezzi, who runs his own research firm, Underlying Inflation. So basically, what we're seeing here is, for a long time, America has been that knight in shining armor, right? That person who steps up, who takes on the debt, who is able to rise above the financial difficulties or challenges. But even right now, we're seeing that the U.S. is slower to step up with those kinds of things, and they're a lot more careful about the things that they're taking on as a whole.
Yeah, and I think if we're being honest about it from a political perspective, just because we're talking about the economy, if you're expecting the government to come in and fix this problem that's been created, I would probably lower those expectations, because I don't think anybody's getting along with anybody up there. The more news that I see when it's coming out of Capitol Hill is just complete lack of congruency and teamwork. Like, the Republicans are changing the speaker. The Democrats and Republicans are not getting along about anything. Our president doesn't seem like he has a clue what's going on with anything to do in the economy. And of course, the Republicans aren't getting along with each other because they're all fighting over who's going to be the candidate for the party it's sort of just something you should expect, that everybody is looking out for number one and they're not looking out for the country. Unfortunately, we are all part of this country. So we all need to be looking out for each other. Do not be surprised if hard times come. Don't think that we're being negative because we're talking about this, because you may be in hard times and just not feeling it right now. It usually takes a while before the decisions that are made from an economic standpoint actually hit you. It's kind of like taking a pot brownie. Okay. I've never done it, but I've always heard the jokes of people that took a pot brownie, they waited, they felt nothing. They're like, oh, I just must be resilient. So they ate 3 more of them. And then about 2 minutes after that, they got hammered, right? There's a lag in the digestion period. And the same is true when they either create stimulus or they raise interest rates. It takes a minute before you feel the effects of it. And we're starting to get the initial effects right now. And it doesn't feel good. It doesn't look good. There's a lot of wealth that was being done in the real estate industry specifically. And that's not just because we're agents and loan officers. I'm talking about people that spend money at Lowe's or Home Depot, right? The employees that Lowe's and Home Depot are going to be employing. Like, you got to think about all the businesses that make their money from real estate investing. And I don't mean owning properties. I mean improving the properties. Like, you put a new fence on your house when you think the value's going up and it's becoming worth more, or if you're going to sell it. You don't do that if it's just you living in the house and you feel poor. You don't spend money to fix up anything. And that has a serious trickle down on the economy in general. And as the people that were making their money through the real estate industry stop going out to eat, stop taking vacations, stop buying as many cars, stop traveling as much, all of the supporting infrastructure starts to feel that too. And then they stop spending money. And that is literally how you get a recession. And I hope that doesn't happen, but it does look like that's the way that we're headed right now.
Yeah, and to take this a step further, right? The US isn't Canada or Italy. It controls the world's reserve currency, and its inflation and interest rates are mostly driven by domestic, not foreign factors. On the other hand, the US also has exploited those advantages to accumulate debt and run deficits that are much larger than those of peer economies. So, in other words, as the United States, we can't just take on this debt and then assume it's not really going to affect other people. In fact, it affects a lot of other countries because we are that primary borrower, right? Investors still project that the Fed will get inflation down to its 2% goal. At 2.4%, real treasury yields are comparable to those in the mid 2000s and lower than in the 1990s, when the U.S. government's debts and deficits were much, much lower. So, David, what are your thoughts on how that impacts us as an economy overall, but really the worldwide economy?
It's a great question, and we'll wrap up with this. If this does indeed happen and the economy starts to grind to a halt, there are 2 ways that this can go. One is the Fed can let the country sink into a recession, which would probably become a depression at this point, and it could get very bad. Okay. The other is they could say, we can't have that happen. Too big to fail, have to look good, whatever the case is. And then they create a bunch of new stimulus, which would be another round of something. I don't think they'll call it quantitative easing. They'll just come up with another word for the same idea, where they create more money and they inject it in the economy. Okay. It's kind of like the plane's coming down. It's either going to crash, or before it does, it's going to skim and it's going to come right back up. We have to be prepared for both options. We don't know which one's going to happen because we don't know what kind of a decision the politicians are going to make, or who's going to be sitting in that pilot's chair when these decisions need to get made. If they print more money, expect real estate values to go up. If they drop interest rates, expect real estate values to go up. Expect that in general, everything will get better. Wealth will start being generated again. The GDP will go up. But the value system, the habits that people have formed that brought us in this position won't change. Which means we will have it again. If they let the plane crash, you will see people losing their real estate. You will see people going into foreclosure. You will start to see another round of really horrible things happening. And if you're sitting there thinking, haha, I'm going to wait, I'm going to buy the real estate when that happens. Well, I hope that you get to, but you probably won't, because you're probably going to be losing your job, or the banks aren't going to be giving out loans to people because they don't know how it's going to work, or the tenants aren't going to be able to pay rent. It's not going to be as easy as you think as to just wait. But if that does happen, you'll see that there's going to be a change in the values of the people and a change in the habits that led to this problem. I think there'll be a lot more humility. There'll be a return to, I need to build up my skills, a little bit of Napoleon Dynamite going on there, because I've heard that girls like guys that have skills.
Yes.
Girls like guys that have skills.
Gotta have my
right.
skill.
And it could be good. Now, both of those routes that I've explained have pros and cons. They have ups and downs. There is no perfect answer. It's just a compromise. So be prepared, have a plan in place for whichever direction that you go, and keep following us for more news as it develops.
I love it. Don't forget, you guys, like and subscribe to this video. We're going to be putting out a lot more live content, specific, up to date information on news, on the economy, on what is happening in the real estate industry. So you can be a part of that and you can get the knowledge straight from the horse's mouth.
There you go. If you hit the notifications bell, you will get told on your phone or your computer when we're going live, and we plan on doing it a lot more. And if you have an article that you would like us to cover, something you think is relevant, send it to Kyle or I on Instagram, and we'll look it over.
Awesome. Thanks, David.
Thank you, Kyle. We'll see you guys on the next one.
See ya.